Welcome to this explainer. Today, we're putting on our detective hats to figure out if one of America's most respected regional insurers is the ultimate bargain or just a cleverly disguised value trap. We're going to completely tear down the numbers for Cincinnati Financial, ticker symbol CINF. We'll analyze their competitive landscape and really dig into the mechanics of a company that honestly, at first glance, seems almost too good to be true.
All right, let's jump right in with a number that usually makes value investors salivate. A price-to-earnings ratio of just 8.5. Now, to put that into perspective, the industry average generally hovers around 15 to 20 times earnings. So we're talking about a massive discount for a company that's been a staple in the insurance market since 1950. An 8.5 PE basically means you're looking at an earnings yield floating around 10 to 12%. Which is an incredibly strong starting point if you're out there looking to buy assets on the cheap.
And hey, it actually gets better. They aren't just cheap, they boast some seriously elite profitability, pulling in a return on equity between 18.37 and 21.48%. That number is huge because it easily clears Warren Buffett's notoriously strict 15% threshold for a high-quality business. Generating that kind of return on shareholder equity means the company is highly efficient at turning capital into pure profit. So far, the picture looks absolutely pristine.
But hold on a second. Just when you think you've struck gold, boom, we hit a glaring red flag. Their combined ratio just crept up to 100.8%. Now, in the insurance world, the combined ratio is literally the holy grail of operational health. Anything below 100, you're making a profit on your underwriting. But anything above 100 means you are actively losing money on the core insurance policies you write. In the second quarter of 2026, their core underwriting business lost $18 million. That is a really sharp deterioration from the $128 million profit they posted the year before. Section 1. The hidden red flags. Let's dig a little deeper into those operational cracks.
When a stock looks this cheap on the surface, it's our job to figure out why the broader market is pricing it at such a heavy discount. The most damning piece of evidence here is a massive 27% miss in core operating earnings per share. Analysts were expecting somewhere between $1.82 and $1.84, but the actual number came in at just $1.43. Now, if you only skimmed the headlines, you might have seen a GAAP net income of $8.05 per share, which sounds incredible, right? Well, that number was heavily disguised by an $882 million investment portfolio gain. The core insurance business itself actually severely underperformed.
And you know, Wall Street is definitely catching on to this. Major firms like KBW, Bank of America, and Piper have all lowered their price targets, shifting the consensus rating to a cautious hold. KBW dropped their target from $201 to $190, BofA lowered theirs to $193, and Piper stepped in with a neutral $175 target. The professional analyst community is clearly signaling that the easy money on this rally, it might have already been made.
The prosecution's case gets even heavier when we rapid-fire some of these other clues. We've got an overpriced 2.19 PEG ratio, meaning you're paying a high premium for very little growth. There's a high price-to-book ratio sitting between 1.6 and 1.8. Guru Focus has flagged 6 separate warning signs. The stock is currently hovering right near its 52-week high of $195. And perhaps most notably, Director Charles Odell Schiff dumped $1.3 million in stock on August 3, 2026. Meanwhile, absolute crickets on the insider buying front over the last 3 months.
Section 2. The green flags defense. Because, to be fair, it is definitely not all doom and gloom.
Remember, we're talking about an institution that has survived and thrived for over 70 years, and they certainly didn't get to this position by accident. The defense's strongest piece of evidence is a virtually non-existent debt-to-equity ratio of just 0.06. In any industry, having almost zero debt is amazing. But in the insurance industry, where unexpected catastrophe losses can wipe out highly leveraged companies literally overnight, it is extraordinary. This pristine balance sheet provides massive financial flexibility, giving them a huge protective cushion when severe weather or unexpected claims inevitably hit.
So the crucial takeaway here is that despite those Q2 hiccups, they still managed to grow their book value by an impressive 19% year over year, hitting $108.64 a share. Their value creation rate, which directly measures how well management compounds intrinsic value, improved to 8%. And let's not forget their Q1 blowout that featured a 119% EPS surprise. They also have massive institutional backing, with Vanguard and BlackRock holding roughly 20% of the company combined.
They sit at a very low volatility beta of 0.65 to 0.80, so the stock swings a lot less than the broader market. Oh, and they reign as a deeply defensive dividend aristocrat, yielding a very safe 2.1%.
Plus, not all analysts are running for the hills over a quarterly blip. BMO Capital and Roth MKM are actually maintaining their buy ratings with pretty aggressive price targets of $198 and $200 respectively. These firms are looking past the short-term catastrophe losses and seeing a clear upside path for this well-run regional insurer. They believe that Cincinnati Financial's long-term underwriting discipline and solid independent agent network will ultimately win out.
Section 3. The Guru Interrogation. Let's see how the investing legends would grade this stock. So how does the father of value investing view this? Well, for Benjamin Graham, the verdict is kind of mixed. On one hand, he would absolutely love the cheap 8.5 PE ratio and the virtually zero debt. But Graham requires buying assets at a steep discount to their book value. Since Cincinnati Financial's price-to-book ratio is sitting between 1.6 and 1.8, it breaks his strict 1.5 maximum threshold. Because of that, in Graham's eyes, there's just no clear margin of safety here to justify taking a massive position.
What about Peter Lynch's framework? Much less forgiving. It hands the stock a brutal failing grade of just 26 out of 100. Lynch's golden rule is that the PE ratio should equal the growth rate. Sure, an 8.5 PE sounds incredibly cheap, but it's totally meaningless to him when the company's growth rate is sputtering along at just 7 to 9%. Because the PEG ratio is sky-high, 2.19, Lynch's framework essentially concludes that the growth is too low, the price is too high, and it is a definitive pass.
And finally, Buffett's framework yields a partial pass, scoring a 51 out of 100. Buffett would heavily praise that stellar balance sheet, the 18% return on equity, and the safe dividend. But he severely docks points because the 7 to 12% return on invested capital misses his 15% criteria. And more importantly, the inherent catastrophe risks in property and casualty insurance make their core operations highly unpredictable. That goes right against Buffett's deep desire for steady, reliable cash flows.
Section 4. The moat debate. Let's talk about their competitive advantage.
That unpredictability brings us directly to the core of this entire investment thesis, evaluating the true durability of Cincinnati Financial's competitive moat. Guru Focus actually grants them a strong 6 out of 10 narrow moat. This is largely thanks to their stellar, deeply entrenched independent agent network and really intense brand loyalty in their core regional markets. But here's the catch. This durable advantage is constantly at war with the rising, completely unpredictable threat of catastrophe-driven underwriting losses. The moat is real, for sure, but as we saw with that 100.8% combined ratio in Q2, it's definitely not immune to severe weather and short-term volatility.
Section 5. The final verdict. Is it a quality discount or a value trap?
We have examined the pristine valuation. We've uncovered the hidden operational red flags, and we've heard from the legendary gurus. If you are keeping this suspect on your watch list to see how the story develops, you need to mark your calendars for 2 highly critical upcoming dates. First is their ex-dividend date in late September 2026, which locks in that 2.1% yield. But far more importantly, keep a very close eye on their Q3 earnings release in late October 2026. That report is going to prove whether Q2's underwriting loss was just a temporary blip or the beginning of a very dangerous new trend.
So I'll leave you with this final thought to judge for yourself. In a world where cheap stocks are often cheap for a very good reason, is an 8.5 times PE ratio actually worth the risk of a 108.8% combined ratio? When you weigh that pristine balance sheet against the totally unpredictable nature of catastrophe losses, where exactly do you draw the line? Keep analyzing, keep questioning those numbers, and I'll catch you in the next explainer.